once you have stability in terms of the interest rate and what's going on in the market, you can actually mitigate for that because your spreadsheet and my spreadsheet, it's a row and a column. For us and for you and for professionals, it's not the actual interest rate, the instability. If you could stabilize it, you can run all your metrics a little bit more confidently.
Do you love your job, but want other investment options than your company's 401k and trying to pick stocks? If so, you've come to the right place. In this podcast, you will get actionable information for your passive real estate investment journey. Welcome back to another episode of Work Hard, Invest Harder podcast. Here's your host, Justin Dixon.
Hey, everybody. Welcome back to another episode of the Work Hard, Invest Harder podcast. I am your host, Justin Dixon, and today we have Dr. Sanjay Sharma on the podcast. He is a practicing physician in hematology and oncology. He is also a multifamily syndicator. We talk a lot about his kind of medical practice and how he helps other physicians and high net worth individuals get access to larger multifamily syndications. We dig deep actually into how to really vet a sponsor or a deal finder to make sure that you can know, like, and trust them enough to invest with them passively or actively. He invests in Southern California, which I've always heard is a no-no, but he talks about living there and investing there, which is super interesting. And then we dig into kind of the markets, what's going on right now, and we really unpack and dig into a lot of things on this podcast. So let's welcome Dr. Sharma to the podcast. All right, Dr. Sharma, welcome to the podcast. Happy to have you on.
Oh, it's great to be on. I'm excited to be here, and it's an honor to be on your show.
Awesome. Well, very cool. Well, let's kind of get started here. Give us in the audience kind of a little bit of an overview of who you are. You've got some scrubs on and you got the MD after your name. So maybe let's talk about you and then we'll dig into some stuff.
Sure. I guess by default, it's kind of obvious that I'm a doctor. You call me doctor. I am a physician. I am a practicing hematologist and oncologist in Southern California, and I'm a real estate syndicator. So the stuff I do is we search for apartments, we buy apartments, we bring investors in, classic syndicators. My classic avatar is, for in terms of investors or other physicians like myself, high net worth individuals and executives who are looking for freedoms in their lives. And that's what we provide. I'd say that's the skinny of me. I'm married, 2 kids, and great family.
Awesome. You said you're in Orange County. I think we talked about that off air. And I guess let's kind of back up a little bit. I guess at what point did you kind of think about real estate or get involved in real estate? Because obviously it seems like being a physician is kind of education and passion. And then at what point did real estate kind of pique your interest?
Yeah. So you said correctly that being a doctor is a lot of education, a lot of study, a lot of passion, as you referred to. So it's a good segue in terms of anything that you develop an interest in. You know, all doctors are multifaceted in terms of the things they like and the things that they see. And, you know, like I said before, and I think all people are in search for certain freedoms, you know, whether that's time freedom, geographic freedom, financial. And as a doctor, I would always say vitality and mindset, which are critically important. And then just kind of growing up, I lived all over the country. You know, I've lived in Texas and New York City and in Virginia and upstate New York and Wisconsin. I lived all over the place. Yeah. So by just naturally, you kind of see what's going on around you. And in terms of real estate, there was a big difference with me going to school and training in St. Louis and in Richmond, Virginia, and then New York City in terms of when it comes to like real estate prices. And I think by that time I was living in New York City, I was married. And I think we were old enough and adult enough to kind of recognize what's going on around us in terms of where real estate prices were going. And I clearly remember we were renting this tiny little apartment in New York City, completely and super happy. And you know, someone's like, "Why aren't you buying your apartment?" And I'm like, wow, you know, apartments are $600,000 for a 2-bedroom. And so I said, "Don't buy the apartment, buy the building." I'm like, who the heck buys a building? Like, Who are those people? Like, that didn't even comprehend. Now I buy a building, but it didn't even make sense to me. And so then I kind of got an itch at that time, still didn't buy anything. My wife's family, they're involved in real estate.
Okay.
Kind of got that itch, but never really got involved. And then I started doing limited partnership. I started doing some passive income stuff.
Got it.
Then I was like, oh, this is how people buy buildings. And then I started seeing what those returns were. And I started recognizing, oh, in terms of when people talk about mailbox money, you know, passive investing and syndication is mailbox money. Like my investors will never drive to the building, will never meet a tenant, will never mow the lawn.
Yeah.
I started getting involved as a limited partner. That led to one deal, to a second deal, to a third deal. When I was like, man, I can do this on my own. But then I started buying my own active stuff. And then I quickly realized, so then I said, hey, you know what, let me do my active. And then it went superbly well. And we bought a duplex and built it to a triplex, and then bought a triplex and then bought a fourplex. Went 2 units to 7 units from 900,000 in purchase to exiting at 3.5 million. I mean, it was beautiful and it was easy, but it still wasn't giving me everything that I wanted in terms of my freedom. And that's how I got involved in syndications, because I wanted to buy buildings and big buildings. Actively raising right now for a 250 unit building in Atlanta. By the time the showcases, that raise may be done. And I wanted to get into bigger and bigger properties. And also, critically important, I wanted my colleagues, I wanted my other physicians that I work with who we share patients with, I wanted them to taste the freedoms that the ones that I'm starting to taste. I want the world to be a better healthcare world when all the physicians are financially free and, have the vitality, have the health, have the mindset. So you asked me how I started, and I kind of dug.
No, that was super good. And I think I want to kind of dig into a couple things here. So you kind of mentioned that you kind of started up passively, I guess. How did you get to the point where, or how did you feel comfortable kind of passively investing your money in? And was that a syndication that you were passively investing in? Like, maybe talk us through that first initial, because sometimes it's a leap of faith, right? Because you need to know, like, and trust the person that you're putting your hard-earned money for. And, physicians obviously make more money than the average American, but you still want to keep a hold of as much money as you possibly can, right? So you're going to be diligent on how you find the people that you're going to invest with. So how did you kind of start that process to find a person that you felt comfortable putting your money passively with?
Yeah. So I'll tell you, my first LP, I had no idea what I was doing. I had no clue, none at all. But you're right. I trusted the sponsor and I trusted the people. Not only did I trust the sponsors, I mean, what the sponsor told me, we're sitting in a meeting, we're talking, this was before a few years ago. So this was before the days of Zooms and webcams and stuff. You would actually be sitting in a room talking to people. And the people that I trusted, and the reason why I invested with these people, they told me, and they giggled, and they said, "Oh, Sanjay, only invest if you don't care about losing your money." I'm like, what the heck are they talking about? I do not want to lose my money.
I always care about my money. Whether
I've never said, "Oh, can I just throw my money out the window and see where it's at?" I've never said that. But I trusted these guys. The deal made sense. I didn't understand the metrics that they were using. I didn't understand the interest rates. It's quite frankly, the education wasn't that good, both within myself and how they were explaining things to me. But I did it because I trusted them. And so I did it. It was a tiny bit of money, but I'm still an LP in that particular deal. And now we're spitting off 30% returns. Wow. I mean, it's just like, that's a project that we're never going to sell. That was the idea of the project. So that was about 12 years ago, I think.
Oh, wow. Okay. Yeah. So you started investing along like a while ago. Yes. And wow, you still own that deal. Like, I'm curious because usually, when you do syndications, there's like a 3 to 5 year horizon. Was it a big deal or was it a smaller deal?
Yeah.
And you guys are just...
Yeah, it was a medical office building, and it was, it was a build. So we went from dirt up, and the idea is that we'd keep it forever. So no, that did well. But I mean, talking about some of the major issues and topics that are needed to invest, you talked about fear, you talked about the sponsor. Because of the sponsor, I didn't have the fear. And to this day, I talk about whenever I'm counseling people on investing in syndication is, you are investing in the sponsor. You're not investing in the dirt, whether it's Tennessee or LA or Atlanta or wherever it is. Not at all. You're not really investing on the economies, although I teach people on how to vet deals. But you're really investing in the sponsor, that the sponsor knows how to run the building, and the sponsor knows how to conservatively underwrite, and the sponsor knows to recognize if trouble is brewing, how to get out of it. And that's the name of the game. And then the other thing, a lot of my first-time investors, a comment I get all the time, they'll say, or a very common that I get is like, "Okay, fine, Sanjay, I trust you. I'm going to try it out." And I always thought it's kind of an interesting terminology to say they're going to try it out. They say, "Okay, fine, I'm going to invest $50,000 on you. Depending on how I feel, maybe I'll invest with you more in the future." Right. But the interesting thing is, if you truly wanted to run that scenario in terms of, let's see how it goes, you would have to wait to the completion of the cycle, right?
Right.
You'd have to invest $50,000 and in 5 years, see how much money you made and then invest again. And what I found multiple times, it's not that they want to see how the deal actually goes in terms of the returns. They want to see, are they comfortable jumping off the diving board and being like, "Okay, that was kind of cool. Let me go back up and jump again."
Yeah.
And it's not like they're saying, "I'm going to do a triple bogey flip" or something like that. They're just like, "Okay, how does it feel to wire $50,000 into a syndication company run by, Sanjay Sharma. And
Right.
that's kind of getting over that fear.
Yeah. And I think to your point, like I've had some multiple investors kind of in multiple deals. And to your point, they want to test you out also to see your process and how you communicate and make sure you're keeping them up to date. Obviously, the deal has to perform and make sure that you're moving in the right direction. But I agree, it would be a long try it out period if it was a 5-year
Yes.
try it out, because you obviously, would miss out on potential other opportunities. So we talked a little about kind of your passive kind of entry point, and then you kind of said, well, let me do this on my own and try to see if I can figure it out. But so I want to kind of learn a little more about the
Sure.
active side. But before we do that, we're going to take a quick sponsor break. So we will be right back.
Whether you're in a job you love or hate, building a financial foundation is important. This foundation can support you by providing passive income, stability in an uncertain economy, or the launching pad for you to start your own business. Great Venture Capital helps busy professionals invest in commercial real estate to build passive income streams, grow wealth, and take advantage of tax benefits. If you'd like to learn more, check us out at greatventurecapital.com or send an email to justin@greatventurecapital.com.
All right, we are back on the Work Hard, Invest Harder podcast with Dr. Sharma. So we started out talking about kind of your, passion around being a practicing physician and also your entry point into kind of passively investing in real estate. So I want to kind of transition to more of the active side, right? Because obviously, being a doctor, you're not working only 40 hours a week. You obviously have a very demanding schedule. So at what point did you kind of be like, okay, well, I want to do this on my own. I want to be more active. I want to get on the other side of the desk. So kind of talk about kind of that transition, because I'm curious to how you fit it into your busy schedule.
Yeah. The one thing that's true about being doctors is we love to study and we're super analytical. And I'm an oncologist, and within the medicine subspecialties, we're classically known as the ones who are big time into research in terms of reading research trials and understanding the statistics of it. So I am trained and I'm innately super analytical. So it took, even though I flippantly said, I was like, oh yeah, you know what, I want to try active. No, it took like hours of study, like tons of podcasts, like blog after blog after blog, questioning and, thinking about things and running spreadsheets and all that kind of stuff. Until finally, I probably was like, I'd be stupid not to try it, or I just kind of give it up. Like, how many more hours can you spend in a day listening to podcasts and reading that? And so then like you were talking about before, that was scary. Buying my first property, that was kind of a scary experience in terms of just the fear of just doing it.
Yeah.
And then it's kind of like what you read. Like when you do it, things just move. I mean, there's a whole industry behind it. You think in your head that you're climbing Mount Everest, but okay, in your head it's Mount Everest, but you got like a million Sherpas next to you.
Yeah.
And, there's ropes taking up to the mountain, and it's really not a mountain. It's like a hill. It's like a hill you could bike up. Because there's so much support. There's an industry. And then you start thinking about like all the listeners today, like when you're driving today, just look around. Everywhere you see is people are living in, I do multifamily apartment buildings. There's apartments everywhere. There's houses everywhere. There's not a spot, no matter where you live in the country, where there's not housing. It's all over the place. So to have this buildup inside that it's so crazy and impossible and hard and only like only certain people can do it, that just doesn't fly. You just got to get over it and just buy something if that's what you're interested in. And that's what I had to do for myself, as scared as I was. And I had to research a whole heck of a lot.
Some people can fall into the analysis paralysis part, right? Because if you overanalyze, then you'll never make a decision, because there is a inherent leap of faith that you've got to trust that you know enough to make an educated decision, right? And so I'm curious about the first deal that you did. It sounded like, and maybe I missed this, but it sounds like your first few deals were smaller, a couple units. Yeah. Is that right?
Yeah, my first was a duplex. Right?
Got it. Yeah. So we started out the same way. My first deal was a duplex. Yours was a duplex. I'm curious kind of why you didn't start with single family, because that's a normal trajectory of active investors, is to invest in what you know, because most people own a home and they're like, oh, I know how to underwrite how to own a home and rent it out and all that fun stuff. So why did you start with 2 units? Yeah. Where was the deal? Let's kind of like dig into the first one. I'm always curious kind of that first deal.
Yeah. So I always felt that buying a multifamily is better than a single family. And then secondly, I recognize that I want to do value add, even though anything under a fourplex is still residential financing. there still is a value add component. And when buyers and sellers are talking about the building, they talk in terms of commercial numbers.
Yeah.
So for example, if you're talking about a single family home, that home that you bought is worth what the neighbor paid, whether you're living in the home or whether you're buying it for as an investment, that's what it's worth. Whereas when you start getting into multifamily, even in the smaller ones, we all look at the income. In terms of the lending world, 5 and up, yeah, you have to. You look at the GRMs and the cap rate and NOIs and all that kind of stuff. But you still do it on the 2 to 4. So that's why I entered the multifamily space. That was always where I was geared towards going and what my interest was. We bought this in Southern California in Long Beach. So, price is an issue. What we pay a ton of money for much smaller properties. And I probably could have bought a 10 unit outside of Southern California for what I paid. So that's what we did. So we bought in a neighborhood in Southern California, which was a clear value add. It was a trust sale.
Okay.
And then we turned it around. And this was before ADUs were popular, accessory dwelling units were popular.
Yep.
But I had read enough and I knew the importance of building units and building square feet. So we turned the garage into a 2-bedroom. So I turned that in from a 2-unit to a 3-unit. Our intentions were to keep it as a rental. And then someone's like, oh, I want that. And we sold it for a really nice profit and a very short course.
So you sold the entire property once you kind of flipped it into a 3-unit. Got it.
Yeah.
Interesting.
Yeah. That wasn't our intentions, but we had an offer we couldn't refuse. So we're like, all right, we'll take it.
You can take that capital that you earned and flip it into another deal. So were you doing this by yourself? Or did you bring an investor into that deal? Or at what point did you start to scale up to the syndication? Because that's always typically where people flow to, is they go start with a smaller deals, kind of dip their toes in the water, make sure they know kind of at least high level what it feels like. And then they go up to the bigger deals, the 100+ units, apartments, all that. So how did that evolution happen? And then at what point did you start raising money?
Yeah, so it's interesting you talked about it because that's exactly what I did. It went from smaller to bigger. I do believe you don't have to start small. You can start big. Yeah. And in fact, if I wasn't buying in Southern California, I would have been purchasing many, many more units than what I did just based on the price that we paid. But quite frankly, I didn't know anyone else. I was not networked enough where I knew people like you and other people. If I would have, I would have jumped into something bigger at the time. So I'm glad, and my wife says that she's glad I did it that way, because you do learn the ropes. And then you do kind of start to figure out things you like and that you don't like. And there's, what's that saying called? Oh, ELF, easy, lucrative, and fun. You kind of start recognizing what it's like. Like some people really dig talking to contractors, looking at design. That's not really my thing. I like to acquire. I like to talk to people. I like to network. I like to meet the brokers. I like to see the spreadsheets and make decisions. So we got bigger and bigger. I did have a partner at JV on a deal. And then from then on, the first deal that I was involved with the syndication was a property size. I would say it's a building that I didn't have access to. And I didn't have access to it due to my expertise. So this guy I partnered on, he was getting deals at prices that I just couldn't get. And that was because he was networked. He had been in the area. It was the same area where I was buying. He was getting things 30-40% below what I could get. So
you were paying market prices. He was paying, the discount, the off-market deals and all that stuff. Yeah. That's why you need to build relationships with brokers if you're active, because, once the mass email gets sent out, it's already been looked at by half a dozen other syndicators and they've already passed for one reason or another, right? So where have you been looking, or where were you looking kind of in the initial phase? Was it still Southern California, or were you kind of going out of state at this point?
Yeah. No, so this is still LA. I still own in LA. So this is LA properties. And so, people kind of get scared about that, but we're from here and we recognize the neighborhoods and we recognize how to operate in the city. Mostly, in fact, when I go to conferences and they say, you do what? You buy in LA?
Well, yeah.
What the heck?
Let's unpack that, because every time I talk to somebody that lives in California, nobody invests in California. It's always out of state. So why California? Because, and I don't know much about the California market other than all I hear is taxes are high. It's hard to evict or hard to kind of, move tenants on. So how did you pick it and why?
So first of all, how do I pick it? Because I'm local.
Right.
So invest in your own backyard. And also being local, you just understand how much appreciation happens in Southern California.
Yeah.
And you also understand how big there's truly a lack of housing in Southern California. There really isn't much housing. So you just see it all around. And then so what that does is your occupancy is very low. Landlording is complicated. It's expensive and it's complicated here. But the rents you get are really fantastic. Like in these buildings, I was getting rents. I bought them, current rents under 1,000. When I exited them, the rents were 3,000. It's just that the demand of housing is so much, and you can recognize also from being from here what the path of progress is.
Right.
Is that there are just dramatic changes, and you can take advantage of it. And then for me, the bigger deal is you just need more money to do it. You need a bigger down payment. You know, you're not getting something for $50,000 down here. It doesn't exist in Southern California.
Right.
But in saying that, we also own in Atlanta, and we also shop outside of Southern California.
From what I've heard, and obviously, hopefully you can correct me, is I've heard if you invest in California, it's more of an appreciation play, less of a cash flow. But you just said that you're increasing rents 2-3 times. So is that true? Like, is California investing in multifamily more of an appreciation play?
I still think it's an appreciation play.
Got it.
So, for example, we just closed on another deal in Southern California, and we're going to bring the rents up really high. And this one is close to the ocean. I mean, this is a very desirable place to live. Our cash on cash is like 5%, but our equity on that is, it's going to double in a short time. So ultimately, I would call that an appreciation play.
Yeah.
I'm not going to become financially free on a 5% cash on cash return.
Right.
That's hard to do.
Got it. No, that's fair. That at least kind of confirms what I anticipated, that the cash on cash was low. I actually assumed it was a little bit less than 5. But I mean, if you can get a 5% plus a 2 to 3x on exit, that's not a bad overall investment. So you mentioned some other markets. So I guess what other markets are you targeting? You started investing passively 12 years ago. Then you did active. Now, what does your portfolio kind of look like, and where is it geographically dispersed?
Yeah. So we're shopping in Atlanta. I do like that market. I do have a personal connection there because my parents lived there for quite a while.
Okay.
And they don't live there now, but so I really saw that city grow like tremendously.
Yeah.
And in the Southeast, that is just a dominant market. Actually, globally, it's a dominant market with the airport there. So I just love it there. And so you see growth, you see true economies going there, you see business staying there. So I like that area. And then there's pockets. We're actually shopping in Indiana also. And the reason is one of our partners has been very successful in Indiana. So we're kind of riding their coattails. Yeah. I have grown up in the Midwest, so I have a familiarity of just being in the Midwest, although I've never lived in Indiana outside of driving through Indiana a million times on my way to college.
Got it. And then what part of Indiana? I've looked at a few deals kind of in southern Indiana, close to Kentucky. Are you kind of more in the Indianapolis area, or?
We've been looking kind of in the South Bend, Goshen area. I have been underwriting some deals in Indianapolis. I haven't looked down closer to Kentucky. I grew up in Cincinnati, and I have family who lives right across the border in Kentucky.
Yeah.
So I've got connections in that tri-state area. I just haven't invested there. Although I did look at this really neat property right along the Ohio River, which looked really neat, just kind of creative and cool. But, you get your eye candy.
Right.
Like, I would love to own that thing, but then it's like, oh, come on. It just didn't make sense.
I had a guest on recently. We talked a lot about taking the emotion out of multifamily investing, because there was a deal here in Austin where I live that it looked good on paper. And also it was like, because I live here and I haven't lived here long, but you can see the progress and see the development going on in Austin. And I was like, oh man, if we can get this deal, wouldn't that be so cool? And we ended up not getting it. But especially with these, bigger deals, you got to take the emotion out and let the numbers really kind of speak. So I want to circle back to something you said earlier about you're really investing in a sponsor. And, we're recording this in early September 2023. The market is not what it was 2 years ago. Interest rates are sky high, much higher than people anticipated, especially if you're doing a true value add deal. A lot of these deals are on bridge debt, variable rate, all that fun stuff. So talk a little bit more about kind of the investing really in the operator or the sponsor, or essentially, for layman's terms, the person that found the deal or is bringing you the opportunity to invest in a deal. So maybe talk about that and how you either coach people or how you really assess who you would put your money with.
Got it. All right. So I'll just make a comment on interest rates because you brought it up, because that really has changed the dynamics, obviously, and everyone knows that. What we talk about internally, and the economists that we follow in our group, is we just are looking for stability.
Yeah.
So in the simplest way you can think about it is, once you have stability in terms of the interest rate and what's going on in the market, you can actually mitigate for that, because your spreadsheet and my spreadsheet It's a row and a column.
Yep.
And then once you have some stability in there, you can make some anticipations and you can make some performance. And that's really what we need. So for us and for you and for professionals, it's not the actual interest rate. It's what's going on. It's sort of the instability. If you could stabilize it, now you can run all your metrics a little bit more confidently.
Right.
So in terms of choosing a sponsor, I mean, what you're looking for is actually everything we're talking about today. You're not looking for an emotional sponsor. Yeah, when we go out and we're marketing a deal, like my stuff says, why I love this deal. And truly, we don't, even though we make it look very nice and we bring a very nice product out into the community, that's not why we love it. It's the metric. And usually like why we love this deal. The next stuff is all about the safety of the deal.
Yeah.
That's what sponsors and the sponsors that I work with, that they stress. It's the safety of the deal. How do I preserve my investors' capital? That's more important than any return. You always read returns 1.7x, 2.1x, 2.3x. But what is the safety of the deal? How are you going to preserve my capital? And then how risky is the deal even within that? And there's different ones. You talked about value added, what we do, what most syndicators do. And then, there's development deals, which carry a different level of risk. And then there's different classes. There's C classes, B classes, A classes in terms of buildings and value add, which carry certain different levels of risk. So what I look for is I want to personally know the sponsors, or I should say get to know them. You do need to know their ethics and their ethos. You don't want to give your money to a salesperson per se. You want to invest your money in someone that you get to know. 2, you want to see kind of the metrics that they use, or if they talk the kind of the safety language.
Yeah.
3, without underwriting the deal, you want to get an idea of what the business plans are and if it makes sense. I mean, you've seen some complicated business models, and then quite frankly, when any of us talk about capital stack, we can make those things sound so darn complicated.
Yeah.
And if they're so darn complicated, are they hiding something in there? So those are a lot of the things I look for in a sponsor.
No, I agree. And I think when I talk to people about passively investing, it is about knowing the person and getting to the point where you feel as comfortable as possible that you know the person that's bringing you a deal. Because sometimes it's a capital raiser, right? It's somebody that they didn't find the deal. So you're betting on the horse that's betting on the horse, right? So there's a little bit of an added kind of risk, if you will. But I think at the end of the day, you've got to just kind of build relationships, to your point, whether that's phone calls, Zoom calls, going to networking events, et cetera, et cetera. Now that we're in this environment, and to your point, if we had some stability, it's a lot easier to quote unquote predict the future or underwrite for the future. Whereas right now we just have no idea, right? So are you adjusting or kind of adjusting your thesis or your strategy given the current market? Like you said, you're raising on a deal, which I guess have you changed kind of how you think about underwriting and how you think about deal metrics or return metrics in this kind of new normal right now that we're in?
So you look for how has this market kind of changed how we approach a deal or acquiring a property?
Yeah.
You look for different avenues, right? Like you talked about earlier, you're hoping to find kind of the off-market deals that are priced accordingly with a motivated seller. Another technique that's used, and even on this deal right now, is assuming loans. There are buildings out there that still have the 3.5%, 4% loans where you can go to the bank and assume those under your name or under your company's name.
Yep.
So that's one of the techniques we're using. I mean, that's definitely something that's makes a deal much more attractive as opposed to then shopping for a 6.5%, 7% loan. Our metrics are still relatively the same because all syndications are really meant for the investor. So we still want to give cash flow to the investor. We still want to give adequate returns with good IRRs. The horizon might be different. I mean, I haven't started underwriting deals to 10 years. We still underwrite like 5 to 7 years.
Mm-hmm.
Despite what I told you about that first deal, which is kind of meant to be held in eternity.
Yeah.
I have seen things come across my desk where people start showing these fantastic numbers and they're underwritten for 10 years, which is okay as long as you understand that and accept that. We haven't really started doing that.
Yeah. I have seen more deals come out that the delta between the short end and the long end is getting longer, right? So they're like, oh, normally it's 5 to 7. Now it's 5 to 10. And, nobody knew 2 years ago that interest rates were going to do what they did. So anticipating what 10 years from now is going to look like just seems crazy. You've got to add a lot of fluff, a lot of safety into that deal to, really be like, yep, I think in 10 years, this is going to be a 5x return. And it's like, I don't know. So it's a little bit, yeah. And also, I don't know if I want to lock my money up for 10 years into, unless it's producing, right? If it's producing, then great. But yeah, just the 10-year horizon just seems like an eternity at the moment, but it is. So
especially what we went through. I mean, I've been in deals that turned in 2 years. You're like, holy cow. Like 2 years is just such a, 2 years is like, you've almost forgotten that you invested the money, right?
Yeah.
But it's like, it's so palpable. It's still kind of like, you can almost still feel it in your wallet, and then boom, you got a return. Like, holy cow.
Our first investment we did passively. Actually, our first two were passive, and one of them sold, one of them refied. And, we invested, I think, in 2020. And so it's like, to your point, it's like, oh, wow, that was great. But now some of the deals that we're in now are like, struggling because it's, they were bought in 21 and, interest rates were different and all that fun stuff. So you mentioned a little bit earlier that you coach people or you talk to physicians and try to help them to become financially free. And I think it's, that's a different, I guess, mindset for a doctor earning the amount of money they earn. Obviously, they've got a lot of expenses if they take loans out for all the education that you guys have to go through and certifications and et cetera. So maybe talk a little about how you work with doctors and physicians and high net worth people. And I think you have an education company and that may be geared towards medical. So that may be a little bit different. So you aren't doing just being a doctor. You aren't just being a syndicator. You've got a lot of other things going on. So before we end this, I want to kind of just hear more about what you're doing and how you don't sleep, because obviously you're doing 18 things.
Yeah, we all sleep, but that's all part of like mindset and vitality, right? I think a lot of people in our space I think we all have a kind of similar, recognize how to prioritize our time for different things.
Yeah.
A lot of us exercise like crazy. A lot of us meditate a lot. So that kind of gives clarity within our 8 hours or 10 hours of a day. So the vast majority of my discussions with my colleagues is about kind of what makes you whole. Where do you see your career? And it's a different discussion when I'm talking to a doctor starting out or a med student or someone like me who's been in practice for about 18 years. We all have different viewpoints and perspectives. And I can recognize those because I've been all along the way, or even the retiring doctors. So it's a lot about where do you see your life? Like, what do you see where you feel content? And how is it to practice medicine now? What's your interactions like with your patients? What's your interactions with your family? And those are truly important to me. Like, I have a particular skill set. I have an asset class that they can invest in. I can help them achieve that. But to me, I want to see how they're doing as a whole person. I mean, I want healthcare in the United States to be better. I want very content physicians who can sit in a room and recognize what a patient needs. We've all been trained that. I trained in a time when there weren't computer and it was sacrilegious if you weren't touching a patient the entire time. And so the sacred moment in the patient room is so important for me. And I want all my providers or all my colleagues to be able to do the same thing. So that's what I'm looking for. And that's why I emphasize kind of the freedoms. It's not necessarily the paycheck or how much you have in the bank. It's kind of what you're doing with your life and where it takes you. And also with health and vitality, I'm an oncologist. I'm a cancer doctor. I mean, I don't want my colleagues or my friends or other people I know to, because of their lifestyle, because of what they're doing, it leads to malignancies. That I don't want to see.
Yeah, I imagine you're in a high stress, and a lot of the doctors that you work with are high stress environments. So the more that you can have a better mindset, vitality, I guess that would kind of come together and make their lives a little bit easier. So that makes sense. Crystal ball for a little bit. You sound like you're very analytically driven. You are in some circles with folks that are kind of way smarter than I am at looking at this. And obviously I look at the reports and all that stuff as well. But like, what are you thinking, the world's going to look like the next 6 to 12 months? I'm seeing and hearing and reading that there's $1 trillion of commercial real estate, not just multifamily, but all commercial real estate that's like coming due, would need to be refinanced by 2025. So, I hear all these things survive till 25 kind of thing and all that fun stuff. So yeah, what are you kind of thinking? We talked about your strategy adjustment, but what are you kind of thinking as far as the outcomes or the outlook for multifamily specifically in the next, 6 to 12 months? Yeah.
So first of all, I don't think any of us in the industry believe the ads, right? I don't think there's going to be blood in the streets. In fact, I was just in the doctor's lounge and they were asking me, I read at the Wall Street that everything's going to be collapsing. And I was like, no, it's not going to work that way. It's going to be, and what I told them, I think the professionals in this field are going to do well because we're going to recognize what good deals are and not so good deals are. And we're going to be poised to purchase. It's a different environment where in the past you could be a little bit sloppy and you could do okay because there were enough buyers out there that you could exit the property. So I don't think multifamily is going to be dead because I think it's fundamentally needed. It's not like we have a magic number of houses in the United States, a price point that is affordable for everyone. that all of a sudden the landlords can be, run out. I don't expect a catastrophe or an apocalypse to happen where the fundamentals of economies just get, especially in the 6 to 12 month. Yeah, there's going to be some people some groups that are going to be hurting in terms of where they are with their debt structure.
Yeah.
But there's also going to be brokers out there who's going to recognize who the buyers are out. And I think it's going to be a lot more silent than it is public, where it's going to get absorbed within our industry. And I don't really think other people are going to necessarily pay attention to it or know about it. There's going to be some sensationalism always, because that's kind of what draws people's eyes to the internet per se.
Yeah, I've seen a few headlines in specific markets. They publicize the big, one guy like had a foreclosure in Houston the other day that I read. And it's like, I think there will be some poor operators that are going to, be hurt. Sure. And I think to your point, there's probably going to be a lot of off-market deals that are going down where somebody's like, I just need to get out of this. They talk to the broker. They have a list of 5 to 10 people and say, who wants it? And those people that are poised and ready to go are going to capitalize. I still think there's good deals to be had. I think you've got to just be networked enough to get access to them because, like I said earlier, once they hit the wire and they're mass emailed, you've kind of already missed the boat. So no, I think that makes sense. I want to kind of transition here because we've taken up a lot of your time in that, which I very much appreciate. So I've got a 3-pack of questions that I ask every guest. Okay. So let's just jump right into these. So I guess what's one piece of advice that got you started or helped you along your real estate investing journey?
Oh, okay. So a piece of advice, I guess it wasn't really a piece of advice. I'll go back to New York. One of my uncles told me to buy the building across the street, which I didn't do because I thought it was crazy. But he put that kind of notion in my head, and I've never forgotten that. So it kind of, even though I didn't know what it meant at the time, it kind of planted the seed to say, yeah, people can buy buildings. Yeah,
it's true. It is a shocking concept to be like, well, don't just buy the apartment, just buy the building and then live in one of the apartments. It's like, well, okay, how do I do that? So then you got to figure out how to do that.
You're like, who the heck does this?
Yeah, exactly. Now you do. So came full circle. All right, question 2. What is your favorite real estate or business book that you're into right now?
So I go back to Miracle Morning. It's not a real estate book, but it's kind of a business and a mindset book. And I do it because I've always been an early riser. Everyone in my family always does. My grandfather woke up at 4. My dad wakes up like at 3. I wake up at 4. And it was just natural for me. And I just liked how the author kind of put a structure to what to do in that morning. So when they say wake up at 4, I'm like, all right, fine, I'm wake up at 4, whatever. And then what I didn't recognize is, like, what do I do? And that morning is so important to me. And I get so much stuff done. You asked earlier, how do you you must work all the time. And even my partner was like, how do you do all of this? I was like, man, you should see what my mornings feel like. It's so darn powerful. I don't even drink caffeine anymore because that morning gets me up and going and gets my thoughts in the right location and lets me kind of explore and create these companies that I do.
No,
and that's
awesome.
Miracle Morning.
Yeah, I've read that book. There's a couple other books that I've read that kind of structure your morning. And it is powerful when you think about waking up with a purpose versus just waking up to go to work kind of a thing, or waking up to do something. It is kind of nice if you have a little bit of a structure, and to your point, can be very energizing for sure. So final question, if you hit your financial freedom number, meaning you can live an amazing life just off of the passive income from your investments, what would you do?
So I'd still be seeing patients. I love oncology. I wouldn't be seeing them as much. I definitely would be traveling to different places at different ways. My family, extended family, actually owns a school in India, which I've never visited. I would love to play a pivotal role in helping to develop that. My kids are going to be going to college pretty darn soon. If they want to see me, in a drop of a hat, I can go visit them.
Right.
So those are the kind of things I like to do.
Awesome. No, I think it makes a lot of sense. So Dr. Sharma, if somebody wants to reach out and learn more about what you're doing and all the different things that you're doing and all that fun stuff, what's kind of the best way to catch you?
So I'm on LinkedIn every day. That's probably the best way. Sanjay Sharma, MD. Reach out to connect, hook you up with our ebooks that we give out for free, teach you and get you the mindset and get you involved in syndications. Like I said, actively raising. This is September of 2023. By the time this airs, reach out to me if you're an accredited investor. And if it's still open, we'd be happy to bring you in or at least discuss what's involved. You can also connect with me on my website, which is excapinv.com. And I'm sure you'll have it in the show notes.
Yep.
But quite frankly, I'm on LinkedIn every day.
Got it. Awesome. Dr. Sharma, really, really appreciate the time. This has been an awesome conversation. I appreciate you being on the podcast for sure.
It was an honor to be here, Justin. Thank you so much.
I hope you got value out of this episode of the Work Hard, Invest Harder podcast, your one-stop shop for education on how you can continue to work hard in your career and have different options to invest even harder. If you took anything away from this episode, please like and comment. I read every comment as it helps me serve you better. Make sure to subscribe and hit the notification bell. That way you won't miss out on more valuable content. If you're watching this video, it means that you want to grow your passive real estate portfolio. The easiest way to do that is to join our investor club by heading to greatventurecapital.com/invest. The link is in the show notes. See you on the next episode.